All right, let's transition into our last segment here today, and loving the conversation here, guys. We're going to now move into Jedi options, and Coach Tyler is the head coach of Team Phoenix over at Tackle Trading. He also is a writer, a blogger, an educator in the options market for more than a decade now. I've known him for a long time. He does great with this, and all you guys out there who are Team Tackle, you know it as well. It's why we give the Sith Lord. Are you Sith Lord, or I guess you're a Jedi, Tyler? I don't want to get the canon wrong. I apologize. It's why we give the Jedi a segment called Jedi Options. He can dig into some concept in the options market. Today, he's going to examine these two companies we just looked at post earnings and break it all down. Tyler, what you got for us today?
Yeah, so what we thought would be very instructive, Matt just mentioned Toll Brothers, nice little post earnings move, and Dick's Sporting Good. What I wanted to do was talk through these two charts and help you see what I see and how I, as an options trader, would think about building trades around these patterns, whether I would enter a trade today. If not, what am I looking for? Part of becoming a better trader is viewing the stock market kind of like you're playing chess. Like a good chess player is good because they think so many moves ahead, right? Like when you look at professional like chess masters playing games, the lion's share of what they do is sit there and think, right? Because they're thinking like 50 moves ahead, right? And they have to think about the implications of, if I do this, then he does that, then I'll do this, then he'll do that. And they're very good at this kind of, just mapping out the possibilities. As a trader, you have to tap into that a little bit and be able to say, okay, I don't know if I would buy Dick's right now, but here's what I'd like to see. And it's really hard to do that if you've never paid attention before, or if you've never tried this before. But the more you trade and the more you see patterns evolve and patterns develop, you'll start to discover, oh, this is typically what happens, right? Like if this is the first time I've seen a stock gap up on huge, good earnings and big volume, I'm probably like, I don't know how it plays out. But what if this is the 500th time I've seen a company gap to a new high with really good fundamentals in a bull market? I could probably think back to the other 499 episodes. Think, what's usually the ensuing price pattern that gives me a good opportunity, right? So that's where I'm coming at. And one, I think, resource here, Tim, I'm going to put in the chat window. You can share it on YouTube if you want. I wrote an article for the Trading Justice newsletter 8 months ago in January on the definitive guide to option strategy selection. So part of this discussion is, why do I like the chart? Okay, what kind of pattern am I looking for? But the second part then is, well, what kind of option strategy piques my interest here? And if you're curious about, okay, well, what exactly are you looking at? I don't have 45 minutes here, so I'm going to condense this. But if you want more information on what are the metrics that I look at to help build the strategy, like what matters, what made me pick a bull call versus a naked put, you'll find more of that in this particular newsletter. Okay. All right. So, and Tim, you interrupt me if you want, but I'm gonna just rock and roll here for a few.
No, you definitely rock and roll. I did drop the link to that newsletter just in the chat in case anybody wants to review it. But yeah, definitely keep rocking and rolling.
Okay. So with this up move, the challenge. Let's start with this. We're not going bearish. Okay. This is the hardest trade in the world to try to go bearish on Dick's Sporting Goods. It's like that's the opponent you want to pick. That's the fight you want to start. You want to pick the company that Matt just said is the best earnings announcement he's seen all year. That's the guy you want to short. That's the one you want to build a bear trade on. So we're not, sometimes I'm a bozo, but I'm not that dumb. I'm not, and maybe it's just I'm not that brave. Okay, I'll pick easier fights than this one. I ain't going bearish. Probably want to go bullish in light of, I don't know, history, the chart, the fundamentals. And see, here's the thing. You could say, well, Dick's Sporting Goods gone up so much. It's like twice as expensive as it was at the beginning of the year. Well, listen up. Value is not just a function of price, right? The proper way to look at it is to look at price versus earnings, or the PE ratio. And Matt, I can't remember if you said this during the show or pre-show, but if the price of a stock doubles, but the company's earnings double, it's not any more expensive. So in this case, if you go back, and I'm cherry picking here, but fourth quarter last year makes $2 a share, trading for $60. Okay. Now it made $5 a share, trading for more than double, 120, 130. Well, look, man, if you want to keep doubling earnings every year, you can keep doubling your stock price and you're not any more expensive from a valuation perspective.
To give you a number on that, Tyler, the PE ratio for Dix is 10.81 right now. So even with this price appreciation, it's still a 10 PE ratio.
Which is incredible, by the way, right?
It's less than it was yesterday.
Mm-hmm.
Yeah, which is so like such a boss move, right?
It really is.
It's like, move over, kiddies. Like, let me show you how to do this. I'm gonna move up 15%. By the way, like it jumps up $18. Now, confirm if I'm thinking about this right. If I'm gonna pay everybody $5 a share in a special dividend, the moment I say that, is all else equal, is not my share price worth $5 more?
Yeah, they're delivering that right back to their investors. Mm-hmm.
Yeah. So it's like it jumps up $5 until the dividend date, then it goes back down $5. But all else equal, this should have gone up $5 just on the dividend announcement alone. Anyways, so all that said, I don't think it's overbought. I don't think it's extended. I think it's such a baller move, like I said, that they went up 15% and their PE ratio went down today. It's almost like, you schmucks, you should have taken this up 25%, right? Are you crazy? So it's got fundamental underpinnings, right? This is not a gap built on fluff. So the question you have to ask yourself is, do you think that it's going to completely crater? That these guys are up in the night and that it's going to completely fill the gap and then break the trend and go to a downtrend? I view that as the least likely scenario. I think the least likely scenario is this completely implodes, right? Because it just flies in the face of the sentiment today, and what everybody analyzed and agreed upon was this thing is doing really well. For them to flip sides, I highly doubt that happens. So my assumption, me playing chess, thinking a couple moves ahead, I'm thinking maybe it pauses a little bit. I hope it does, because it'll make it easier. I wouldn't mind this either pulls back a few days, gives me a nice little 2, 3, 4 bar retracement if we're lucky, kind of treat it like a bull retracement, buy the dip and then it pops. I could see that as one potential scenario. I would prefer this not fill the entire gap. When you get a gap of this size, you really don't want it to fill the gap immediately, because it's kind of a sharp rejection of the euphoria. Given the size of the gap here, I prefer it not fill the entire thing. I'd still like it. I'd still be bullish if it did. I'd still buy the dip probably. But in light of the magnitude here, I don't know, 120 or so. Okay. But it doesn't have to play out that way. That would require supply to overwhelm demand. That's what causes prices to go down. This thing could just chill out and go sideways for a couple of days, right? Just give me a little base and then it breaks out and goes higher. We don't know which way it's going to play out. All I know is I'm interested in the next tradable pattern, right? And I could show you lots of examples of other, like Qualcomm had a nice up gap on earnings, and then a little bit of a pullback, something like that. So I struggle to pull the trigger. I'm like Tim, right? Tim earlier said tricky to build a trade today. I would concur with that, particularly because it's like right now it's kind of a doji. So like since the open, it went down, it went up, and it's back around the entry. It's like, I don't know. So I would prefer a couple more bars, which means if it rips higher tomorrow, I might miss it. Like I might miss it, unless I'm just really anxious to get some exposure. So I need a few bars is the point on the technical read. Now, what kind of strategy would I do? Look, in a situation like this, you take a look at the volatility. Options were expensive going into the event. And Tim, probably not expensive enough in hindsight. I don't know that this was pricing at a 15% move.
Correct.
So as high as the IV was, it probably wasn't high enough. But you're getting the volatility crush, right? So the news is out. The uncertainty has passed to a certain degree. So vol is coming back down to price in normal movement. Still could be high enough to consider selling options. My favorite, 2 ideas here, okay? I don't think you need to fiddle with naked puts. It's a little too expensive for naked puts. Covered calls, not my favorite here. I wouldn't do diagonals. I think I would either like this enough to do a bull call vertical or go the higher probability route and see if I can sell some out of the money bull puts, right? So I'm always partial to bull puts. if I could get down to like 110 here, Tim, sell a 110 put, buy a 105 put out to October, maybe 6 weeks out, I don't mind that trade. But again, it's tough for me to pull the trigger, and the analysis will change tomorrow and the next day as the price moves. Right.
And let's stay on this point for a minute, because both of those are vertical spreads. I mean, anybody out there who's done some study in the option market, trading in the options market, those are the typical verticals. Your bull call spread, the way that we construct them in our playbook, Tyler, a little bit more delta of a trade, right? You know, at the money call option that you're going to buy, selling out of the money call option. Then your bull put is more of a theta trade. I don't think you can answer the question which one of those spreads you should play until the day you've got your entry point. But you know that it's going to be in that field of one of those two, because look at the volatility coming down here. I still think volatility's got room to come down. If you look at the last couple of earnings cycles, in March, volatility gapped down and then it faded lower for the next couple of weeks until it finally bottomed and started the cycle over again, right? Look at that beautiful volatility build into the earnings. That was a wonderful one. So it gave you that little rotating cycle. Same thing in June, volatility gapped down, it faded for a couple of weeks. So the last couple of times it's done it, it just depends on when you get that exact entry point on that next trigger as to whether or not I would lean bull call or bull put, but that's where I would be headed towards as well.
Well, it's a good point, right? Because maybe this pulls back for 4 days and vol just gets decimated and you're sitting at an IV rank of 0. I mean, look, if you got that good of a pullback into support with an IV of 0, then you're probably going to do the bull call, right? Versus if it just pulls back a little bit and the vol maybe stays high and you can get far enough out of the money, the bull put is still interesting.
Yep.
Yeah. So I 100% agree. Maybe that's good on Dix, unless you want me to build those out, but you kind of explained them.
No, I'm good. I'm good, because you're projecting out what you got to do next. This is a watch list idea. Now the trader has to continue to watch implied volatility and the chart. As soon as those things align, then you have your opportunity.
And here's the thing, like I know the 110, 105 bull puts around 50 cents for October because I looked at it earlier. But if this pulls back a few bars, Tim, I mean, if this pulls back enough, we might be talking about doing a 195 bull put. You know, like this could really sweeten the deal a little bit as the trade develops. But right now, you really can't go much further than 110 if this thing just rips higher tomorrow. So we'll see. But the point is, if this was not on your radar, it just grabbed you and shook you by the head and said, you have to now pay attention to me. All right. So the next one is Toll Brothers. This is a little bit different type of stock for 2 reasons. Number one, it's half the price at $63. So that immediately opens the door to other types of strategies. Verticals are fair game with anything that's more expensive. You can do it on $1,000 stock. You give me around $60 and things like naked puts, covered calls, diagonal spreads become a possibility. I'll get to that in a second. As far as the chart read goes, this was kind of an inverted head and shoulders pattern. Left shoulder, head, right shoulder. Failed the first attempt on the breakout, then came down, but succeeding on the second. And as we talked about, the sectors in fuego here. So I love the breakout. This is not making you chase near as much as DKS was, right? And so easier for me to build a trade and pull the trigger right now on Toll Brothers than it is on Dick's Sporting Goods, right? Because even though this is up 4 bars in a row, it's not up that much, and you just got a fresh catalyst with the earnings announcement. So I'm less concerned with how much this has gone up. So strategy-wise, where's my head at? Well, the volatility is pretty low. So the IV rank, 17th percentile. If you're in the lower quartile of the 1-year range, I'm usually leaning towards buying options in some capacity. And I kind of know that Toll Brothers isn't a huge mover. So I already know its options in general aren't all that expensive. So I'm sure you could build a bull put or a naked put if you wanted to. It just doesn't excite me that much, right? So I kind of prefer either a bull call vertical if I want to go more directional, or maybe a bull call diagonal, which is kind of like a poor boys cover call. Now, I also know that Toll Brother options don't have as many strike prices in the normal monthly cycle. So honestly, I'm going to just have to see what can I build? What can I build? Okay. So if I was trying to do a poor boys cover call or a diagonal, normally I want to buy out a couple of months and sell short-term options against it. if I go to December, I would be okay buying the 60 strike. That's about a 65 delta. I'd rather not buy the 77 delta because I don't want to pay $1,000. It's too expensive. So I'm going to buy the 60, pay $7, and then selling an option against it. I'm actually going to start with October. So I look at October and I say, is there an out of the money option that makes sense to sell? Well, normally on a covered call, we sell around a 30 to 40 delta, slightly out of the money. 45 delta is a little too high for me. 23 delta is a little too low. I kind of wish I had something in between 65 and 70. This is the one instance where I'll entertain looking at a weekly option and see if I can find the right delta. But it's got to have good liquidity. So I'm just going to look at the weekly that's closest to the monthly I was using. And honestly, when I look at the open interest, I'm like, I don't know, man. I'm not in love with the open interest. I'm a big stickler on liquidity. Okay. And so I think I got to stick with selling October if I'm going to build this. And I probably sell the 23 delta, which is the 70 strike. You get $1. Overall cost is $6.30. I don't mind this trade structure. Okay, I'll pull up on the risk graph here for a second. So I don't mind this trade on Toll Brothers. But you could build a cheaper trade if you wanted to with a bull call vertical spread. So I'll get into that if you want me to, Tim. But ultimately for me on Toll Brothers, it would be between this and probably an October, probably 65-70 bull call, unless they have a 62.50, which they don't. So yeah, the other option would just be this $5 wide bull call for $1.63. If I wanted to go a little bit more aggressive and or cheaper.
Well, the diagonal is an interesting call here. Back on the chart for a second, because you have a different implied volatility structure that's happened immediately. Dick's had the much more pure version. You could have taken a picture of Dick's volatility build into the volatility crush, and you could have put it in a textbook or a blog to use it as an example, right? Toll Brothers also had a volatility build and a crush, but now the volatility crush has brought it back down to more historic levels. I wouldn't say there's a lot more room to fade here, maybe a little bit more room to fade. So staying on the diagonal side is an interesting one. The only problem I have with December, October is knowing how that's going to work. Is going to be just as balanced as a Vega trade as a theta trade, right? So you are really playing the volatility as well as theta there. I don't mind the concept. $6 leaves you with positive theta if it has upward movement. It's kind of a simulated covered call almost a little bit there, Tyler, because you're going deeper in the money. There's some interesting things you could do there. Are the technicals ready for you for an entry point on that sometime like soon? I mean, you're much faster or quicker to a path to entry on this than Dick's. So is that where your head's at?
Yeah, I would have bought it today.
Yeah. Gotcha.
Because think about it. If you didn't get in today on the breakout and it goes up again tomorrow, you're certainly not going to get in tomorrow.
Mm-hmm.
Right? I mean, if you think you're late today, then you really think you're late tomorrow if it's an update, right? So if you're not getting in today, then essentially what you're saying is I'm waiting for the next pattern. You either pull back or pause and give me another breakout, which is it just broke up today. Mm-hmm. Or you pull back. I think so. You either like it enough to pull the trigger today, or you're probably waiting a few days to see if there's some kind of secondary setup that develops.
Can you do one thing for me, just analyzing this one? Then we're at the end of the segment. I just want to look at one thing though. If you can, go to the Analyze tab on that diagonal on Toll Brothers. Yep. Build me one with the December 60 and the September 65 instead of. I know it's a very tight delta. I just want to look at the comparison on the risk graph. Yeah, I don't like that because then if it becomes too bullish, and this was a very strong report, you then have a break even to the upside instead of profitability to the upside. That's why that delta thing you were looking at, you were instinctively looking for a little lower delta to avoid the problem on the right side of that risk graph. Is that where?
Yeah, and that's one of the reasons why Toll Brothers is a little bit trickier to trade. If we were on Apple or SPY or something that has strikes in $1 increments, you can structure it however you want. The issue with Toll Brothers is you have the 65 strike or you have the 70 strike, and $5 is a pretty big move for Toll Brothers. So it's like you either sell like an almost at the money call with a super high delta, or you're selling a pretty far out of the money call. Between the two, Tim, gun to the head, you got to go with the lower delta call because the trade structure, the risk graph, the profit zone just fits your bias better, right?
Because it's got a bullish bias. Yeah, I got
Yep.
you. I'm with you. Matt, come back on here if you can. Thoughts on the discussion here in Jedi options with Tyler?
Oh, I just thoroughly enjoy the conversation every single week that you guys have on Jedi options. So once again, as I usually say, just thank you for that. And if Toll Brothers, and the second thing I'd like to say is if Toll Brothers post earnings has ran too much, remember it's not just Toll Brothers alone in this sector. The sector looks pretty decent as well. There's other potential trades. You got Lennar that's hovering right underneath the 110 breakout channel. Pulte Group is looking at a potential reversal as well. And DH Horton looks like a trigger above its resistance pivot as well. So Toll Brothers could be front running something that's happening in the sector. So if Toll Brothers has ran too much post earnings and dealing with some of that volatility, there's other potential trades here as well because these home builders love to kind of move together.